Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at White Charts. Get excited, y'all. The Future Proof Festival is right around the corner. Cambria team will be there. And not only that, but White Charts will be there. They're taking over with a speaking session that digs into the latest client communication survey. The results they found, let's just say, if you're an advisor, you may want to pay attention. A while back, I talked about a few of the eye-opening stats White Charts uncovered, like how 75% of clients either switched or seriously thought about switching advisors last year. That's a massive jump from the 48% recorded in their survey the year before. Luckily, you'll be able to connect with White Charts at the event and have them show you around the platform's powerful communication enablers, like proposals for the spot-on personalized reports to showcase your winning strategy, Report Builder to make every investment conversation count, and their scenario tool for running what-if situations like a pro. And if all that won't get you to the booth, maybe their ice cream stand will. Click on the link in the show notes to download White Charts' full survey findings and get 20% off your initial White Charts professional subscription when you start your free White Charts trial, and tell them that Meb sent you for new customers only. I've used White Charts for years. We love it, so be sure to check it out. Our guest today is Doug Greenig. Doug is the CIO of Florin Capital, diversified systematic manager. He's been involved in markets for over 3 decades. Most recently, Man AHL, chief risk officer, head of portfolio management group. Doug launched Florin Capital 2017 with a focus on trend following. You know, we love it. We're going to spend a lot of time on that and other topics today. Doug, welcome to the show.
Well, hello. Thank you for having me.
Where do we find you today?
Well, I am in Abu Dhabi.
What's the vibe there? This is the first live podcast we've done from Abu Dhabi. We just did one in Lake Como. What's going on? How's things over there?
Well, it's a little quiet during the summer, but in general, Abu Dhabi, UAE, and the region are growing by leaps and bounds. It's a very, very exciting part of the world. A lot of hedge funds, high net worth individuals are located here, and the economy here is booming. It's fantastic.
Perfect. Well, we're going to get into all sorts of stuff. You have had a storied career with a lot of famous names, Goldman, Man. When did you get bit by the trend following bug? Where in the timeline would that have been?
It was relatively late, actually. And so if we go back, I think it was about 2012, 2013, Man AHL was looking to bring in some fresh blood, someone with a lot of experience in different parts of the business. And so I fit the bill. The area where I arguably lacked special expertise was their field, the CTA space and the trend following space. And when I got there, it was very exciting for me because it was so different from the work that I had done in discretionary trading, fixed income arb, all the different things I had done over the year. Credit. You know, I've seen a lot of different things, and the trend following space is different. But coming at it with that background that I did would be a little bit like returning to college, but with the kind of wisdom and experience you might have as an adult. You would read Moby Dick differently. You'd listen to the history class, and it would be different for you. I was able to look at the trend following world and think about it with a fair bit of sophistication, but also the open eyes that you have from not having been indoctrinated into it. Like you can ask the question, why do we do things this way instead of that way? What if you did the opposite? And so on. Like one of the things I learned very early on, it became apparent to me, is that trend followers trade volatility every bit as much as they trade trend. Because volatility, this is true for almost all traditional CTAs. You scale volatility relatively rapidly. You're always adjusting position sizes to be proportional to signal strength. And that means that when vol doubles, all else equal, you cut positions roughly in half. But you're doing that at a very rapid time scale. In many cases, a more rapid time scale than the trend signals themselves. And so the question is, what happens if you don't do that? Well, you lose about half of your Sharpe. Okay. What's this mean? Well, I connected this up in my mind with kind of a Minsky framework. So narratives develop in markets, trends occur, you see big market moves, and then at a certain point, the narrative begins to change. There's new information. Maybe positions are too crowded. And at that point, there will often be a burst of volatility as a new narrative emerges and trends change direction. And by scaling volatility rapidly, that burst of volatility is sort of a signal to get out. And that insight that came to me as I looked at how CTAs approach the world.
Do you remember what really struck you about the strategy, maybe as sort of like the status quo at the time? So from not an outsider, but from someone who was kind of really digging in, as particularly interesting, but also particularly like, well, I wonder why they do it this way or frame the narrative this way. Maybe they should be thinking about XYZ. Anything come to mind from those earlier days?
Well, one of the interesting questions is portfolio construction. So we know trend followers in general understand how to trend follow individual markets, whether you're talking about people in the David Harding tradition or the tradition of the US CTAs. And so again, you're looking at trend signals, either oscillators, breakouts, or related kinds of signals. And then you're looking at volatility scaling. But then how do you put a portfolio together? What's the best way to put a portfolio together? And that is a very, very interesting topic. And by the way, there aren't so many definitive answers. At Florin Court, we sort of favor a maximum diversification approach to portfolio construction.
Let's talk a little bit about that, because y'all do this a little differently, or a lot differently, depending on what you're comparing it to. Maybe tell us a little bit about the base overview of Florin and what y'all do, because it's a pretty fascinating departure from kind of, I feel like most of the CTAs or trend followers understand this very key concept, but you guys have like taken the dial and and turned it up to 11 or 12.
Imagine you start with 5 or 6 assets, and you're trying to trend follow those assets with typical CTA models. And by the way, these models tend to be pretty highly correlated with each other once you control for frequency. On average, 20-day holds, 5-day holds, or 200-day holds. So these the different trend models that one might use tend to be pretty related to one another at the end of the day in terms of the correlation of trends. So you start with these 5 markets. And what you will notice is your Sharpe ratio isn't very high. It's not very high on the individual markets, and it's not going to be terribly high on 5 markets unless you happen to pick cocoa here, or you choose the right moment to short the yen, trend follow the yen. And that's because trend following is a low conviction strategy. You're going with the flow. You're going with the trend. And when things get more volatile, you cut risk. When things get less volatile, you expand risk. And so it's a sort of a relatively low Sharpe ratio world that you're living in, but with an excellent positive skew and some good correlation characteristics. But you go from 5 assets to 25, things improve a lot. Then you go from 25 to 50. In general, you get a fair bit of improvement. And most developed market CTAs trade about 100 assets, mostly futures and FX forwards, dollar yen, Bund futures, S&P futures, crude, all the standard stuff that you can think of. They trade about 100 of them. And a natural question which arises is, can you add more uncorrelated assets? Because if you can, the famous, was it Ron Kahn and Richard Renaud's fundamental theorem of portfolio management, this risk-adjusted performance is breadth times scale. And if you increase diversification, all else equal, same level of skill, things improve. Things basically go up with the square root of the number of independent bets. The Sharpe ratio, the square root of the number of independent bets you have on. So it was an idea that certainly was very well developed in AHL, but other people had it as well. That what about adding more markets? Creating new kinds of markets. Trend in Rotterdam thinks about things like this. CGAs think about it. So with Florin Court, what we did is we tried to say we're going to create a maximum diversification portfolio with as many alternative markets as we can trade. And we're going to just do those because anybody who invests with us probably has already invested in a developed market standard CTA. And so we're going to add, in a way, diversification to that allocator's portfolio. We're going to diversify, they're diversifying. And so we now trade close to 500 alternative markets, ranging from Turkish interest rates to onshore Chinese commodities like methanol, to California carbon emissions, to Chinese containerized freight, to Chinese base metals, credit default swap indices. It's quite the list of markets. And then if you're going to try to do this in all these markets, then construct your portfolio in a maximum diversification sort of way to get the full benefit of all these markets.
I know you love all your children equally, and as a quant trend follower, you got to be somewhat agnostic, but do you have any special part in your heart for any of these particular weird and esoteric markets where you're like looking at this portfolio, you're like, you know what, I just really love California power, whatever it is. Are there any where you're just like, this is one that speaks to me?
I don't want to sound fickle in my affections. Okay. Over the years, power markets, electricity, carbon emissions, natural gas, they've been very, very exciting markets that move a lot. And this has a lot to do with the elasticity of supply and demand. And for example, 2021 and 2022, those were spectacular years. The Ukraine war played a role in this in terms of really profound, huge trends in the power market. You also get special things like EDF, Electricité de France, will sometimes shut down parts of its nuclear fleet to do maintenance. And then you'll have a spiking and a decline in French electricity prices. So power markets historically have been very interesting. Right at the moment, they're a little bit quiescent. We've actually returned in some respects to pre-Ukraine war sorts of levels. At the moment, however, the carbon emission markets are very, very interesting. California carbon emissions are interesting. The freight markets historically have been quite interesting and diverse. The different routes are different. For example, Chinese containerized freight was one of our best markets this year due to the disruption in the Red Sea of shipping traffic and how that's played out. I've always liked crypto a great deal. We were involved fairly early. It's not a huge part of our portfolio, which is a part I have a fair bit of affection for, in part because fundamental value is so elusive. Trend following is particularly well suited for a world where fundamental value is elusive, where there's an underlying instability in the economic environment, political environment, and international relations. It's sort of very well suited for this kind of postmodern world that we're in, where we can't really be sure of very much beyond the next few months, perhaps not even that.
As you look across adding or subtracting these new markets, I mean, that's order of magnitude more than many traditional managers will target with their gold and oil and yen. I know they're kind of two sides of the same coin, but when you look at them, is this the magical non-correlation? Is that the main thing you're kind of thinking about as you add these? Because as a trend follower, you kind of come to this with the belief that there is the potential expected returns at some point on something that may trend. But it seems odd that more people wouldn't come to the same conclusion that you have, I guess is the way I'm trying to think about this, more being better.
It's a good point, but it's a lot of work. It's not necessarily fun work. Don't watch the show Billions and think that's our life. Instead, there's just a lot of heavy operational lifting. My two partners, David Dennison and Tony Unitsky, are doing a lot of heavy lifting. When we add 30 or 40 new markets in a year, the entire team is working very, very hard on that. Now, in some ways, it may be less sexy than making some tweak to a model, right? Trying some slight variation of the system that you've used. Maybe you can get a slightly better back test. But it's my claim that it's lower hanging fruit. I don't mean to mix metaphors, but everybody's trying to wring alpha out of like this towel, this damn towel. And one thing you can do is just squeeze harder and harder and harder and try more and more different models. And by the way, you can get arbitrarily good back tests if you do enough overfitting and things like that. But it's a different orientation to say, I'm going to take the tried and true models that have worked well, and I'm going to apply it over here to California carbon emissions, or I'm going to apply it over here to freight markets, or I'm going to do the work so I can trade Turkish interest rate swaps and sort of go through this whole process. We were one of the very early people involved in trading onshore Chinese commodity markets with offshore money. And so we did the work to do that properly and legally and appropriately. And so I think one issue is it's just a lot of work. Number two, there's not that much capacity. You do all this work, and our capacity for what we do is in the neighborhood of $3 billion. Okay. You're not going to be able to do a $20 billion fund with all of these alternative markets and have them count. Because you want each market to be capable of moving the needle. You don't want window dressing where you say, well, these 100 markets don't really count. These 50 are the main ones. That defeats the purpose of this diversification.
I think you're almost there. Rare are the days where investors will talk about capacity and actually cap it. You're pretty close, man.
A very common question that I get from allocators, particularly those who are new to the CTA space, is what would you do in the CTA space? And I said, there are several good alternative market CTAs, and we think that we're one of the very best. It's good to have some of that. Get yourself a good developed market CTA for a certain part of your risk. Maybe even look at one of the high-speed CTAs to add to the positive convexity in the developed markets you care about. That's probably about the best you can do. Okay. We have the higher Sharpe ratio. In our experience, because of the greater diversification and the fact that the markets that we traded seem to be somewhat less efficient, to trend a little better, we believe that our Sharpe ratio is closer to 1 than to half. Whereas I think the regular CTAs are somewhere about half as much or something. And then, of course, higher speed CTAs tend to have a great skew, but they give up some Sharpe. But if you put it all together, you get something that's really quite good.
An additional benefit in my mind, thinking about all these markets, is you have the position sizing that you referenced, that if you do have a headache, the headache is smaller. I'm thinking of like sort of the LME fiasco of a couple of years ago. It's 3-4 years ago. I don't even know at this point. But thinking about some of these markets and some of these being esoteric, and it's same for me. Like we talk a lot about angel investing on this podcast, and very similar dynamics where I got a lot of friends that will do angel investing, but they may only invest in 5 or 10 companies. And I say, you really need to get up above 100 to even feel remotely comfortable in my mind. But I've kind of taken what you guys have done, but to the extreme there. And so for me, it's been personally over 400, because I'm like, to get some of these big winners, the math helps you when you get to be a higher size of these different opportunities. And I think this year on the traditional CTA trend world, this became apparent with when you reference cocoa, where it's something that most people traditionally wouldn't think of as they're focusing on the yen, they're focusing on gold. And then you get all of a sudden all these returns from something that's esoteric. Same thing with y'all with California Power or Turkish, who knows what. What tends to be the biggest disqualifier when you're looking at new markets? Is it capacity? Is it just pain in the butt of operations there, of having to trade some of these? What are the main things that kick them out?
We take a perverse pleasure in overcoming operational challenges, which is the kind of sad commentary on us, I think. No, it's more the case. First hurdle is it needs to be different from what we have. Having a slightly less liquid version of what we already do in some other market, that's not desirable. Sometimes we'll take a market, we'll throw it out and go into its close cousin, which is more liquid and better behaved. So we can do that. So some of while we might be net adding 35 markets in a year, might be a total of 50 being changed. In some cases, switching from one to another. So we're looking for something that's diversifying, different, has adequate liquidity, because we need to be able to do it in enough size that it matters. Now, our standard in that regard is a little different because we have a relatively flat and even portfolio allocation across 500 markets. By the way, your observation about a portfolio of venture positions and how it pays to have a large number of options so that you can experience those tail events, okay, is very insightful and quite correct, in my opinion. And that's exactly what we're doing. In a certain sense, what you said is what we do in the CTA space. That's a nice way to put it.
You got to get a little bit of a philosopher hat too, read a bunch of your writings. And so let's say you're hanging out in London or Abu Dhabi or somewhere, and you're talking to a pension fund or a family office who historically hasn't been in the trend following space. And they say, okay, I got two questions for you. And I'm sure you've answered these 1,000 times, similar to kind of how we have. The first question is, I don't get, why does this work? Help me out. I'm a traditional equities person. I do endowment style portfolio, but I really like this idea of trend following, but it sounds kind of arcane to me. What's your answer for this?
Well, my answer is, in some ways, it is a little mysterious and arcane. It's not the simplest thing. But one of the profound behavioral biases that we can't get over, it's just so hard, is anchoring bias. And what that means is our sense of where things ought to be is too heavily shaped by where they were. I remember I think it was 2009, 2008, okay, when interest rates had already dropped a great deal due to the financial crisis. A very, very experienced, smart investor I know asked the question at that time, Doug, do you think the 10-year can get below 2.5% or something? I forget the exact number, but it was a number that subsequently ended up seeming very high compared with where things got in subsequent years. But the reason the person is thinking that is they take where we've been and then they say, okay, let's take 50 bips off that or 75 bips. That's kind of where things can go. I remember people asking it short, and this is a good question. Fisher Black actually had a discussion when we worked together in 93. We're having a debate whether interest rates could go negative, including policy rates. And this came up in the issue of derivatives pricing, because you had a choice of using a normal model for the short rate or a log normal model, or there's a square root model that's kind of in between. I think that's Tatsu or Solomon Ross's model. And the question is it okay to use the normal model because that could potentially allow negative short-term interest rates? And Fisher and I both thought that it was possible. And I think everybody thought we were crazy, including us. Okay, so we realized it was a little bit out there. But that anchoring bias is very powerful, and it tends to prevent things from moving perhaps as far as they should. There will be people who fight some powerful trend based on where things have been in the past. It doesn't flow naturally to some new level. Now you might say, but how do you know the right level? Well, that's partly why you have anchoring bias. You don't. So you rely a lot on the past. And so anchoring bias, I think, is a big factor.
And once you see anchoring bias and you understand it and talk with your friends, you see it everywhere. Like you can't unsee it.
Indeed. By the way, you see this with the way equity analysts approach their forecasts. They'll sort of take where you've been, project up or project down, but within a kind of certain range. And I'm not saying, and by the way, mark my words, I'm not saying I can do better, because it's hard, but I'm saying it affects the behavior of markets and it creates trends.
You think in terms of, you listen to your friends, bought the stock you told me to at 100, it's down to 80. I'll just sell it when it gets back to 100. There's so many of these sayings you hear from people, and I feel like people are much more fearful with their profits. You buy something at 100, it goes up to 120, 150. You're like, oh my God, I can't believe how much money I made. I got to sell it. And in no scenario do you think of the possibility that could eventually be a $300, $500, $1,000, $5,000 stock. And listeners, just start to pay attention to some of these anchoring ideas. And then once you hear them, see them everywhere. Housing is a big one, certainly for people, and as they think about housing.
Oh yeah, that's a lovely example. You're putting out a lot of great examples there. So that's one issue. Now here's another one: leverage cycles. Think about the deleveraging that took place in the U.S. housing market and the way there was a feedback loop. Soros used to refer to the best macro trades as having reflexivity, positive feedback. But those positive feedback loops often involve either leverage or the opposite, deleveraging. Okay. And you see that both at the level of big market moves, like housing booms or crashes, but you also see it at the level of individual trades, where more and more people start subscribing to the idea, let's say, using the yen as a funding currency. And okay, I'm going to buy some nice, juicy Latin American currency, a nice high real yield. People get into that, and then the thing twitches the wrong way, and there's the trend up, then the trend down. Okay, so that's another source of these trends: leverage cycles and reflexivity in general. And then, last but not least, we don't really know what fundamental value is. This ties in with the anchoring issue. And you have to almost kind of let it play out. The markets that trend the best are the markets where no one is quite sure what it tends to really worth. Things that don't trend well are Fed funds futures for 1 or 2 meetings out. That's just an actuarial game. Did you know what I'm saying? Of course, it moves sometime. You really need to go out to like the 1 year out or 2 years out, $1, where you start getting into some real expectations about the future. We were just talking about the next Fed meeting. It will have this kind of key characteristic. It doesn't trend according to some narrative, like higher for longer, or real interest rates are too high right now. That kind of.
So the second follow-up question there, all right, Doug, we hear you, we like you, we like this concept of trend following. How much should we slot in to our very traditional endowment style portfolio for allocation? So not just to you guys, but trend as a whole. What do you think the Barra optimizer would say? How much should we allocate to this as a strategy?
Well, it kind of depends on what you're trying to accomplish, what your goals are. And there's one role that trend can play, which is a risk mitigation role, in which case you want to favor faster trend following programs. You want more skewness in the program. There are a number of programs I think are really excellent out there, and we provide some. Or there are other people that can actually give you a nice solid Sharpe ratio and some of this skewness and some diversification. So what I generally would encourage people to do is I give them some of my returns and let their analysts put their portfolio together with what I'm doing. And then sort of let them try to decide what return profile they want. Because we don't exist in isolation. But then again, no investments exist in isolation. You always want to try to look at this thing together. And so I try to give people a good recommendation on what they're trying to accomplish. If they're trying to get protection against the S&P going down, then we're certainly uncorrelated, but we're not a tail protection product against the S&P. Although if the world ends, we'll probably do pretty well, partially ends. On the other hand, if you'd like a trend following program that's pretty uncorrelated with what you're doing now, not that correlated with existing trend following programs, and hopefully continues to deliver a Sharpe ratio close to 1, which is very high for a trend following program.
You do a lot of writing and on the macro environment. How much of that is like curiosity because it's in depth and it's well thought out? How much of it is sort of happy hour, going on a walk with friends chat? Because what I'm leading into is how much of this is describing the lay of the land versus working its way into how we think about portfolios or how you actually implement any of the systems.
Most of this is for my interest and pleasure. Like you, I think of myself as a student of markets and a student of investing. And many of our clients like to have some interesting insights to take into investment committee meetings and just some thoughts that they can bat around. But I enjoy having those, okay? And it just so happens that a lot of the ways I do think about the world tie out with the general desirability of having a more long volatility perspective. I was thinking about what basic aspect of my worldview is a little bit different from other people. And so I started thinking about, there's a guy named Francis Fukuyama. And he's sort of a neoliberal icon. He's like the ultimate, in a way, Davos man. Maybe I'm being unfair, Francis. I apologize if I am. He wrote a book called The End of History and The Last Man in 1992. And this was on a moment of American triumphalism. America's at the absolute relative peak. And the general view was the West, we have it all figured out. We know the kind of political system and economic system that we need. By the way, I think the US in the mid-90s was actually running slight budget surpluses. But at least we aren't running big deficits. There was a point. I mean, things were going very, very well. And my basic view of the world is the exact opposite. I don't think we have very much figured out. And the older I get, the less I seem to know. My sense is our political system and our system of governance has flaws that I, for one, don't know how to fix. They're very structural. Short election cycles, but we need to make policy for 5, 10, 20 years, not the next news cycle. I think about how inequality is increasing rapidly. It's not because of the Democrats or because of the Republicans. It's because we're living in a world where technology and globalization amplify talented people. There'll probably be somebody watching this podcast later in like Jakarta, but hopefully they'll get some value out of it. But the point is, if you have something to say, if you have something to offer, whether you're Taylor Swift or a much less known figure, the point is that reach and amplification creates tremendous inequality. The differences are just much greater. And that's creating an unstable dynamic. And of course, we're in a multipolar world. There's going to be great power competition the way we haven't seen. And so I'm looking at a world filled with instability and uncertainty. None of these things are probably foreign to you at all. The fact of the matter is, how are you supposed to invest in a world that is so uncertain, unstable, dynamic, and non-stationary? And so I think there's a very good case for thinking about had to deal with details, with trends that you couldn't even imagine. How many people thought NVIDIA would become what it has? Some did, but certainly it was not anything like the market consensus.
And it's back to almost knocking on all-time highs here in late August. I think that stock is, $3 trillion now? So who knows? But it's been fun to watch, that's for sure.
It's extraordinary, and I'm not an analyst of the value of NVIDIA stock, but people are correctly perceiving that the world is changing in a very deep way. AI is absolutely amazing. We have a very close relationship with the MDZ University of Artificial Intelligence here in Abu Dhabi, which has just an amazing faculty. And they're doing really, really interesting work. So the world is changing in all these ways. So to your main point, we are systematic. My views about the world do not really influence how these models work. It can influence some of the markets that I look at. So I'm very, very interested in the energy transition. So if I can add markets that are involved in energy security and energy transition, that's an area that's very exciting. Obviously, the Chinese commodity markets are incredibly important as well. Trade markets. There are a lot of things that the world that I've described impact. And so that shows up in our very extensive market list. But we're fully systematic. And the views that I express are more for my benefit, the benefits of the reader, and also people who are interested in the question, how do I trade a non-stationary world that's dynamic?
One of the things you've said is when narratives change, there tends to be a burst of volatility. I think the world not too long ago maybe saw some of this with Japan this summer, some pretty quick jiggles in a few different directions that seems to have subsided a little bit. But could you maybe elaborate on that concept, or maybe even give some examples on how you kind of think about that narrative shift and then all of a sudden the burst of volatility and what that implies?
In the case of Japan, I would say the issue there is it became quite apparent over time that Japanese monetary policy is out of alignment with the rest. And it's out of alignment for two reasons. One is that inflation has been falling steadily, with some choppiness in the US and in most European countries. But you can see the dynamics behind inflation by examining, for example, the Visia M4 money supply, which is now pretty well behaved. We had this monetary expansion, inflation, and now things are pretty much back on the trend line. And so with inflation coming down and policy rates as high as over 5%, real interest rates are very high. So the fall of inflation sort of caused real interest rates to look higher. Then you go to Japan, and seemingly out of nowhere, after 3 decades, Japan's having some inflation. I think the Japanese inflation is running over 2%. The policy rate at 0. So that disjunction gave rise to a very big carry trade. The real thing was just the sudden recognition that maybe the Bank of Japan is not going to sit there and just let this happen. So when they popped up interest rates and talked about reducing their bond buying, it shocked people out of their position. I would say that one place where the change in the world has become quite apparent, has even shown up a little bit in the markets, is the US does not have the omnipotence and control that it once did. I want you to consider Operation Prosperity Guardian, where the US tried to reopen the Red Sea when the Houthis made a decision that they wanted to squeeze Israel by shutting down Red Sea shipping traffic. As the US formed this coalition, and you have to remember, Yemen is a poor country. This is not Russia or something. And yet, Operation Prosperity Guardian, in the view of most military analysts, has been pretty much a resounding failure. And that ended up really causing some significant shifts in shipping rates. So this is an example of I think people were surprised by how ineffective this military operation was, and the fact that shipping was as disrupted as it has been. That would be an example. Probably we're going to see this issue that the U.S. is not being able to call the shots the way that it wants to. We're going to see more of this in the coming years with potential impact on specific markets.
You talk about gray rhinos. What are those?
But I like gray rhinos. So you have this bestiary. Is that the right term of all these different kinds of risks? You have Nassim Taleb, who introduced the concept of the black swan, and is certainly an interesting character. A gray rhino risk is a risk that is just sitting right in front of you, and it's there. You know it's there, and you don't really do anything about it. For example, the size of the U.S. debt, the fiscal position of the U.S. I don't know if you've taken a look at Congressional Budget Office estimates of where things are going to go, or the Penn-Wharton budget model, which is a similar thing. And it is absolutely frightening where the debt to GDP ratio in the U.S. is headed. This is not a false alarm. Am I using the right term? I'm not being a Cassandra. This is a serious thing. And we're going to have great difficulty addressing it, because almost all of the solutions will be politically unpopular and therefore will not happen. Austerity is not going to happen. Putting up taxes will be very, very difficult. It is a very, very serious situation. Already, interest payments on the debt exceed the combination of the defense and intelligence budgets right now. And if they don't, I'm off by the tiniest of amounts. We're approaching essentially $1 trillion a year. That's the great rhino. Climate change is the great rhino. It is happening slowly but surely. And I believe that quite firmly. It's not just some left-wing conspiracy. It would be a wonderful thing if it were. I wish develop later. But actually, read Václav Needle's book, How the World Really Works. It's a great book on energy, climate. There were scientists 100 years ago who more or less worked out the trajectory of putting all this carbon in the atmosphere. So it's just that it's happening so slowly that we don't quite know what to do about it. There isn't enough urgency. And it's hard to get that urgency because it's a problem not for tomorrow. And nobody wants to slow the economy down. At least I don't. I'm certainly in favor of capitalism and growth, and all the good stuff that makes our lives nice. And so you don't want to interfere with that. At the same time, you look at what the consequences are likely to be, just on a precautionary basis. A lot of our big cities are right there at sea level. I was there when Hurricane Sandy flooded New York. Doesn't take much more to create a lot of trouble. So that's another gray rhino. I know there are people who don't agree with me and will say, Doug, don't buy it.
That's actually one of our usual closing questions, but since you mentioned it, let's chat about it now. But investing belief, you go sit down with a group of peers, doesn't have to be trend followers or quants, just people in the investing world. What's a belief that Doug would say that it's got to be the vast majority, 75% of people would disagree with you about or shake their head? You say this at lunch tomorrow and they're like, what is he talking about? He's crazy.
I would say one view is I'm more bullish on China by far in the long run than other people. And I reject most of the standard arguments. But of course, there's the demographic issue. But what China is attempting to do is essentially, through the Belt and Road Initiative and other things, tap into a huge pool of inexpensive labor in the global south and climb the value chain very, very hard. China graduates more highly qualified engineers right now than the rest of the world combined. China invests, as a percentage of GDP, their investment is about 40%. It's a multiple of what it is in Western countries, including the US. And I realize there are difficulties in the Chinese political system, but already China is leading in the publication of papers in very high quality journals in a variety of subjects. The quality of the academic and engineering work out of China is rising and rising fast. I'm not necessarily frightened by it because I see myself as kind of a global person. I want everybody to do well, including the Chinese. It doesn't have to be the case. But I think the vast majority of Western investors do not appreciate how successful China will be over the next 20 years. And I don't think it's necessarily a bad thing. By the way, it's already happened in electric vehicles. You go back 5 or 10 years, how many people would have predicted where we are now? What is it, 90%, 95% of all green tech investment? Some huge percentage is done in China.
I feel like people get stuck in just focusing on Chinese equities. They look at Chinese equities and they kind of just, they go up and they go down, they go up and they go down. Currently more down than up, but they haven't really gone anywhere in a certain amount of time. And that's what they extrapolate as the progress, as the success of what's going on over there. Now they're really cheap now, certainly relative to where they have been. But just the scale and numbers is often hard to comprehend. And we love talking on this podcast about certain things that really frame it and go back to anchoring, but talking about things like popularity outside our shores of certain things. Soccer is the most obvious example, but even things like talking about cricket in India and other places like UK, where there's like more fantasy cricket players, people that do fantasy sports than there is in the US of like total fantasy users, right? So like people focus on their little world and then learn things like this. And it's fascinating, but China just being so, and India too, obviously being so big, the numbers and the scale is almost hard to comprehend.
I know. My dad was a Midwesterner from Oklahoma, was in the Navy, went to Columbia Business School, and I'm a dyed-in-the-wool American who had a Harley Davidson motorcycle that in the English countryside, slowly and carefully, my dad on the country roads. And so I have a very American view. And I think we have an amazing quality of life in America. It's wonderful. It's a wonderful, amazing country. But I'm saying there is a little bit of insularity. People don't understand how transformative the global South is and how China is in particular. They're a country that's working on, like the UAE, and I did, on a 5-year, 10-year, 20-year, 30-year plan. And it's not about an election cycle. They're turning out an extraordinary number of fantastic scientists and engineers. We argue that they don't consume enough. We argue that they need to be like us. They need more consumption, less investment. And probably they do need less residential investment, although it's probably their real estate investment is probably down 30% or something like that. That's what it was. I make an argument that all of this investment has created a tremendous infrastructure there and is turning out a huge amount of human capital. And I think it's an exciting and good thing for the world. So I'd say my non-consensus view is I reject both the complacency and the negativity that people feel about China. I know China, of course, has a real estate recession. They have some problems.
What's been your most memorable investment? Probably been thousands of trades in your career. This could be personal. It could be with work. It could be good. It could be bad. Anything come to mind, seared into your brain?
One memorable moment was early on 1994. And this was at the end of the tightening cycle. And there was still another 200 or 250 basis points of tightening built into the Fed funds curve, the Eurodollar curve. And I asked because this was an early experience, it was very memorable. I asked myself a question. If the central point of the distribution is 200 more tightening after all the tightening they've done, are we can we assume some slight symmetry? Are we saying that 300 and 100 are sort of equally likely? 400 and 0? It's too high if you have to assume that much asymmetry. By the way, this applied recently. Remember when the Fed, we were pricing 6 rate cuts this year, something like this. This is back in was it January? Fed cut 6 times. So you're sort of saying cutting 8 times and 9 times is equally likely versus 3 times if you impose symmetry. So at the time, I bought Eurodollar futures then. And I remember there was weak retail sales in early 95. And it's just boom, that whole hump to the curve just collapsed. That was very memorable. When I was at Greenwich Capital, we had a lot of very successful trading in mortgage derivatives like inverse IOs, WAC IOs, NIMs. And again, these are effectively interest rate derivatives that essentially have bets on curves and typically a lot of spread. So you're trading essentially a package of options. So I always enjoyed trading options. And so I like synthesizing them from the long side. It's a trend follower. Optionality has always been of great interest. And I think in the world we're living in now, the optionality from synthesizing volume, trend following is particularly valuable.
It's been super fun today, Doug. Thanks so much for joining us.
Thank you very much.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.